So, today we're going to talk about something that I think every single one of us has experienced at some point. And that's the most common mistakes in trading. And I want to say this right up front. This is not a video to point fingers at anyone. I've made most of these mistakes myself. Honestly, almost everyone who's ever traded has gone through them. It's completely normal. But here's the thing. When we understand why we make these mistakes, when we see what's actually happening beneath the surface, fixing them becomes so much easier. And just to set the stage, if you look at CFD and Forex brokers, the ones that are legally required to publish their data, somewhere between 74 and 79% of their retail accounts lose money. That's not an opinion. That's documented regulatory data. So this isn't some rare problem. We're talking about something that affects the vast majority of us. And today, I want us to explore why together. So what we're going to do today is walk through 5 groups of mistakes that keep showing up, not just in my trading, but across research, data, and the experience of traders everywhere. The first group has nothing to do with charts or strategies. It's about our brains and how they're actually wired against us when it comes to trading. Then we'll look at the psychological traps that pull us in, the behavior loops that drain our accounts, and even how the trading environment itself is designed to push us in the wrong direction. And finally, we'll talk about something that's a bit dry, but honestly might be the most important piece of the puzzle: position sizing. Now, by the end of this video, I'll share what I've been doing personally to work on these mistakes. But to get there, we first need to understand the root causes, because once we see the full picture, the solutions start to click naturally. So, let's start with the one that surprised me the most. Here's something most of us never think about. Our brains, the actual hardware running our decisions, were not designed for trading. They were designed for survival, running from predators, finding food, avoiding danger, and that sounds like ancient history, right? But the problem is, when we take a trade and it moves against us, especially when there's real money and leverage involved, our brain responds to that loss in a way that's remarkably similar to how it would respond to a physical threat. Now, the real neuroscience is way more complex than this, but the simplified version is, our emotional responses tend to override our logical planning under financial stress. And that's enough to mess up our decisions. Have you ever had a trade go against you, and suddenly your entire plan goes out the window? You freeze. Or you panic sell at the worst possible moment. That's not weakness. That's your brain doing exactly what it was designed to do, protecting you from a perceived threat. And here's what's fascinating. Brain scans have shown that experienced traders process risk in a completely different way. Their brains have been conditioned through repeated exposure. The fear response is still there, but it doesn't hijack their decisions the way it does for someone newer to trading. So the first thing to understand is, our brain is not broken. It's just running old software in a new environment. And when we recognize that, we stop blaming ourselves for reacting emotionally. Because everyone does. It's literally built into us. But this is just the first layer. Because on top of this biological wiring, there's a whole set of psychological traps waiting for us. All right, so we've got this brain that's wired for survival. Now let's look at what that actually does to our trading decisions, because this is where it gets really relatable. There's a concept from behavioral economics called loss aversion. And what the classic research suggests is this: the pain we feel from losing money is roughly twice as strong as the pleasure we feel from gaining the same amount. So losing $100 hurts way more than gaining $100 feels good. Think about what that does to our trading. Let's say we make $200 on a trade. Feels good, right? But then we lose $200 on the next one. Even though we're at break-even, it doesn't feel like break-even. It feels like we lost. And that asymmetry shapes everything. When we're in a winning trade, we get nervous. We want to lock in that profit before it disappears, so we close early. But when we're in a losing trade, we hold on. We tell ourselves it'll come back. We wait for break-even, because closing that trade means accepting the pain of a real loss. And this isn't just theory. This is one of the most well-documented behaviors in trading. We cut our winners short, and we let our losers run. Almost all of us do this at some point, and it gets worse, because when the market keeps going against us and we're holding that losing position, our brain does something sneaky. It starts looking for information that confirms we're right. We ignore the price action. We scroll through social media looking for someone, anyone, who agrees with our thesis. And before we know it, we're averaging down into a losing trade, adding more money to a position that's already underwater. If you're nodding right now, don't worry. We've all been there. But this behavior doesn't stop there. It feeds into something even more destructive. So our brain is wired for fear, and our psychology pushes us to hold losers and cut winners. That's already a tough combination. But then we add behavior on top of that, and this is where things really spiral. Let's talk about FOMO first, fear of missing out. We see a big move happening, maybe a coin or a stock just shot up 30%. And even though we had no plan to trade it, even though it wasn't in our setup, we jump in. Because the idea of missing the move feels worse than the risk of a bad entry. And the thing about FOMO trades is, they almost always come at the worst possible time. We're buying after the move has already happened. We're entering with no plan, no stop loss, just emotion. And more often than not, we end up on the wrong side of the trade, buying at prices that are already stretched while others are taking profits. Now, when that FOMO trade goes wrong, or any trade goes wrong, something even more dangerous can happen. Revenge trading. We feel wronged by the market. We want our money back. So we size up the next trade, skip the analysis, and fire off another position, trying to recover immediately. And revenge trading almost never works, because we're not trading from logic anymore. We're trading from emotion. And one bad trade turns into two, turns into three, and suddenly our account is down significantly. Not because our strategy was wrong, but because we stopped following it. And I think a lot of us have been there, staring at a losing trade late at night, telling ourselves it'll come back. It doesn't. And instead of closing it and going to sleep, we open another trade to try to make it back. By morning, we've lost more in those few hours than in the entire previous week. That's when it really hits. The damage isn't coming from the market. It's coming from our reaction to the market. Now here's the part most people don't talk about. All of these behaviors, FOMO, overtrading, revenge trading, they're not character flaws. They're predictable responses. Once we know they're coming, we can prepare for them. And that shift alone, from reacting to anticipating, changes everything. So far, we've been looking at what's happening inside us, our brains, our psychology, our behavior. But there's also something happening outside of us that we need to be aware of. Modern trading platforms are deliberately designed, to keep us trading. Push notifications about trending stocks, top movers tabs, confetti animations when we execute a trade. These aren't neutral features. Studies have actually shown that these design elements increase trading volume by over 5%. They trigger the same dopamine loops as social media or even slot machines. And then there's social media itself. Financial influencers, finfluencers, posting their wins, their calls, their predictions. And when we see someone we follow making a confident call, it's really hard not to act on it, even when we know that most of these calls don't come with risk management, position sizing, or any kind of follow-up when they're wrong. And here's what the research shows. When retail traders pile into a stock because of influencer hype, they often end up buying at the worst possible time, right when the price is most stretched. The early buyers take their profits, and the latecomers absorb the loss when the price corrects. Now, this isn't about blaming anyone or feeling like victims. It's about awareness. When we know these forces exist, we can make conscious decisions instead of reactive ones. So we've got biology working against us, psychology pulling us in the wrong direction, behavior patterns spiraling, and an environment that amplifies all of it. That's a lot. But here's the good news. Once we see the full picture, we can actually do something about it. And it starts with something surprisingly simple, but incredibly overlooked. Okay, I'll be honest with you. This next part is probably the least exciting section of the whole video. It's about numbers and percentages and math. But if there's one part of this video that could genuinely save your trading account, it's this one. Let's talk about position sizing. Because most of us, when we take a trade, we focus on the entry, the setup, the indicator, the pattern. But we treat how much we risk almost like an afterthought, and that's where the real damage happens. Think about it this way. Let's say we have a $25,000 account, and we use a simple rule. Never risk more than 2% on a single trade. 2% of $25,000 is $500. That means we'd need to lose 50 trades in a row, 50 consecutive losers, to blow that account. That's an enormous amount of runway. But without that rule, if we're risking 10% per trade, just a string of 5 or 6 bad trades, and we're down more than half, and now we need to double what's left just to get back to where we started. The math of drawdowns is brutal, and there's a smarter way to do this, where we adjust our position size based on how volatile the market is. When volatility is high, we trade smaller. When it's quiet, we can trade a bit bigger. This way, the actual dollar risk stays consistent, regardless of what the market is doing. It's like adjusting our speed based on road conditions. Now, I know this sounds simple, maybe even boring, and I don't want to oversimplify. Risk management alone doesn't guarantee success. But without it, failure is almost certain. The traders who survive long enough to get good, they didn't survive because they had the best strategy. They survived because they managed their risk first. So now we've been through the 5 big areas: brain, psychology, behavior, environment, and position sizing. The question is, so what do we actually do about all of this? All right, so we've gone through a lot. We've seen how our brains work against us, how psychology pulls us into traps, how our behavior compounds mistakes, how the environment is designed to exploit all of it, and why position sizing matters more than most of us realize. So what do we actually do? Well, here's what I've found helpful. And I want to be clear, I'm still working on all of this myself. This isn't a lecture. This is just what I've noticed makes a difference. The first thing is paying attention to our own psychology, and the simplest way to do that is journaling, not just the trade details, the entry, the exit, the P and L, but the emotional state. How did I feel before the trade? Was I calm, or was I chasing? Was this a planned setup, or was it impulsive? Remember the cognitive dissonance we talked about earlier, where our brain cherry-picks information to confirm we're right. Journaling is one of the most direct ways to counter that. When we start tracking our emotional state, patterns emerge fast. And once we see the patterns, we can interrupt them. The second thing is having a clear method and sticking to it, whether it's price action, indicators, order flow, whatever works for you. Pick one approach, test it enough that you trust it, and then execute it consistently. Not switching strategies every week, not jumping from indicator to indicator. The boring consistency is where the results come from. And the third thing, and this is what I've found makes the biggest difference, is accepting that any single trade can go either way. We will never know what happens next on one individual trade. But here's the thing, over 50, 100, 200 trades, a good method with proper risk management starts to show its edge. So we stop trying to predict each trade. We stop taking losses personally. We just execute, manage the risk, and let the numbers play out over time. That shift, from trying to be right on every trade to trusting a process over many trades, that's honestly the biggest change I've experienced. And it didn't require some secret technique. It just required letting go of the need to be right every single time. This is what I wanted to share from the beginning. Now, these might sound like things you've heard before, and honestly, they probably are. But the difference is now we understand why they work. It's not just generic advice anymore. It directly addresses the biases and behavior patterns we've been talking about. It's not complicated, but it is hard, because it means rewiring habits that our brain naturally resists. Now, if you're watching this and thinking, well, it's too late for me, because you've already blown an account, or you're in a deep drawdown right now, I want to say something. It happens. It happens to a lot of people. And the most important thing right now isn't the money that's gone. It's what we do next. And what I've seen from traders who've come back from blown accounts is that the recovery almost always starts with the same steps. First, just stop, take a break, let our mind get back to a calm, logical state. Second, when we come back, trade with very small amounts, much smaller than before. The goal isn't to win back the money immediately. The goal is to rebuild confidence and prove to ourselves that we can follow a process. And honestly, this might sound counterintuitive, but many well-known traders went through blown accounts before they became consistent. Now, not everyone who blows an account comes back stronger. That's the reality. But those who do almost always point to the same thing. They finally took risk management seriously, in a way they never would have otherwise. So if that's where you are right now, you're not done. You're just at the part of the journey where most people quit. And the ones who don't quit, they tend to come out the other side better for it. So let's wrap up. Today we went through the 5 big areas where most of us make mistakes. Our brain's survival wiring, the psychology traps, the behavior loops, the trading environment, and position sizing. And the takeaway isn't that trading is impossible or that we're doomed to fail. The takeaway is that these mistakes are predictable, they have clear causes, and once we see them clearly, we have a real shot at doing things differently. We don't need to be perfect, we just need to be aware. And every time we catch ourselves about to make one of these mistakes, even if we still make it, that awareness is a step forward. I'd love to hear from you. Drop a comment and share which of these mistakes you've experienced. Or if there's one that hit close to home today, I read all the comments, and honestly, it helps me figure out what topics to cover next. If this video was helpful, consider subscribing. I'm going to keep making videos like this, where we explore trading not just from a strategy perspective, but from a mindset and risk perspective too. Thanks for watching, everyone. Take care of yourselves, and I'll see you in the next one.